In the first part, we saw how Janet Street used the concept of put call parity and arbitraging to pocket the massive gains. But here is the real twist. This profit didn't come just from the theory, they came from action. Let's dive into this step by step to unfold their trading pattern and why SEBI called it a manipulation. Let's watch this video till the end. So you can see from Jan 1 23 till March 31st 25, Janet Group has made a huge profit of 43,289 crore. So let's discuss what methodology they have applied for identifying the disputed trading. So out of this profit, this whole profit actually, it is made through these index options. So out of that, through using these Bank Nifty indices, they have made 17,319 crore. So what it is for? So what SEBI has done, they have identified or calculated the daily profit in Bank Nifty indices. So Bank Nifty indices was identified for further examinations. So daily profit was computed for these Bank Nifty indices, and out of that, all these days it is ranked by the profit. So 30 most profitable days it is shortlisted. So top 30 days in which they have made the maximum number of profit, all those days were identified. Mind it, all those profit they have made through the options, index options. So out of that 30 days, 19 days it is found that it is the expiry days, monthly or weekly. So out of all those expiry days, the most profitable day was the 17 January 24, on which day they have made 734.93 crore. So our discussion, it will be focused on this particular day, because on this particular day they have made the maximum profit. Okay. Now, before discussing further, let's try to understand the basic relationship between the spot prices and the call and the put option prices, and how does it affect the buyers and the sellers. So as we have discussed in the call put theory, call put parity theorem, we have discussed in the previous video. The link of this video will be provided after this video. So as per that parity theorem, when the spot prices increases, so here we will discuss the spot prices of the indices, mainly the Bank Nifty indices. So when the spot prices of any underlying asset will increase, call option price will increase and the put option price will decline. So when there will be an increase in the option price, if it is a call option price, if it increases, automatically the buyers will gain and the sellers will lose. And when the option price reduces, here in case of these put option prices, when it reduces, the buyer will lose and the sellers will win. Similarly, if the spot price reduces, here in this case it is the Bank Nifty indices. So when the spot price reduces, the call option price will reduce, but put option price will increase. So when there is a decrease in the call option price, naturally the buyers will lose and the sellers will win. So in case of any decline of any kind of option, always the buyers will lose and the sellers will win. And when the option price increases, here in case of this put option price, the buyers naturally they will win and the sellers will lose. This is the normal theorem of the relationship between the spot and the option prices. Our discussions, all the discussions, it is based on this particular theorem only. So before discussing further, we need to understand this basic relationship. Now, let's see what was the trading setup of Bank Nifty indices on 17 January 24, because we have already discussed that our discussion will be focused only on the 17 January 24, because on this particular day they have made the maximum profit. So this is a chart of the 15 minutes, and from here you can see that the previous close of the Bank Nifty, it was 48,000 over 48,000, but on 17 Jan it has opened with 46,573. So here you can see that immediately after opening the market there is a sharp decline. Okay, but after that, few minutes after that, you can see there is a sharp rally in the Bank Nifty indices. After that, the decline starts. Okay, so here you can see that immediately there is a sharp decline. There is a consolidation after that. Again, there is a sharp decline. Again, there is some consolidation. Again, the sharp decline. And this declining phase, it is continuing till the end of the day. This is the trading setup of the Bank Nifty indices. Now, let's look at the stocks. The stocks are the component stocks of the Bank Nifty indices. So, if you want to influence the Bank Nifty indices in the spot market, you need to influence its component stock. So, out of all these component stocks, we have taken the major 4 stocks, the chart of the major 4 stocks. So on that particular day, that is the 17 January 24, let's have a look at the chart of the all major 4 component stocks of Bank Nifty. So here you can see that HDFC Bank, there is a sharp decline, there is a sharp rally. After the gradual decline, it is continuing. In case of ICICI Bank, Axis and SBI, the similar trading pattern you can see, that there is a sharp decline at the very immediately after opening the market. After that, followed by a sharp rally, then the gradual declining starts. So here you can clearly understood that the component stocks, the pattern, the chart pattern of the component stocks and the chart pattern of the Bank Nifty indices is completely same. That means ultimately you are influencing, if you are influencing these component stocks, the Bank Nifty also, it will follow the similar way. So similar kind of impact you will see on the Bank Nifty indices. Now have a look at what is the intraday trading pattern they have followed on that particular day. So the entire day time period we have divided into the majorly two windows. First, we are terming at patch 1, that is the initial part of the day, and the later part of the day, we are terming it as a patch 2. Now patch 1, we have further classified into 2 parts. One is the patch 1A and the patch 1B. So the first half of the day, that is from 9:15 in the morning till the 11:46, that in this time period the patch 1 will continue, and in patch 2 it is 11:49 in the morning till the end of the day. Now see, in the first patch of the day, what are the actions the JS group or the Janek group has taken. So you can see here they have purchased the Bank Nifty constituent stocks. We have already discussed about the constituent stocks. Their chart pattern we have just now discussed. So in the cash and future market, they have bought 4370 crore of Bank Nifty constituent stocks in the cash market as well as in the future market. So what is their basic objective behind this, basic intention behind this purchase of this Bank Nifty constituent stocks in cash and future market? Their intention was to push up the prices of the Bank Nifty constituents. So if they can push up the the component stock, then automatically the index, same impact will see in the index also. So index will also rally. So their intention to push up the index. So that is why similar kind of chart pattern you have seen, that initial part of the day, after opening the market, in the initial part of the day, there is a sharp rally in all the stocks as well as in the indices. So why they want to push up the indices? Because in that case, automatically the put option will become cheaper. If the put option becomes cheaper, then call option will become expensive. So when there is a sharp rally in the spot, so automatically the call option will become very expensive and the put option price will become very cheap. So that is the impact they wanted. So similarly, so see, we have already discussed in the previous part the Janek Group, the role of arbitrager they have played. So role of arbitrager means parallelly they will take two positions, one in the cash market and another in the derivative market, here in the options market. So when they are buying in the option in the cash market, in the Bank Nifty constituent stocks, parallelly they have taken the bearish position in the Bank Nifty index. So what they were doing, what was their action? They were just buying the put options, because just now we have discussed that when there is a rally in the spot, the put option price, it will be very cheap. So they are buying that same cheap put options and the call options will become very expensive. So they were selling the expensive call options. So that was the action parallelly in the options market. So as you can see here, that the position that they have taken in Bank Nifty indices option, it was 7.3 times of the long position that was taken in cash and future segment. So this is the first part of the day. Second part of the day, that is the patch 2, what they have done. Now they are squaring off their positions. So whatever buying position or long position they have taken earlier, now they will take the short position. Okay. So therefore, what they have done, that they are reversing and sells practically all the net and cash position in the Bank Nifty constituent stocks. Okay. So what is their intention? When they are selling, their intention is to create a downward pressure on the Bank Nifty component stocks and the index. So if there is any downward pressure on the index, then automatically the put option price will rally. So put option in the first part of the day, they have bought at a cheaper price. So when there is a rally in the put option price, then they can sell it at a higher price. And in the call option, what they have sold at a higher price, now since there is a decline in the call option value or drop in the call option prices, they can buy it and make huge profit. So this is the trading pattern they have taken on 17 January. So they have made a profit in index options, but they have made a loss in the cash and the future segment. But whatever profit in the index option that they have made, that was more than the losses that they have made in cash and future segment. Now we will examine this trading in a detailed manner.